This is the protection meeting, life insurance talk. So John and Mary, as we get to the bottom here, you see life insurance is the last one, and we have it listed as underprotected. So if I click John on the word life insurance here, we can see that you have two policies. You have $100,000 of group life insurance that your company provides, and you have $500,000 of term life insurance through MetLife that you've purchased previously. So again, if we take the situation of the auto accident that we talked about earlier, where you're driving through the intersection, you have an accident, but instead of it being someone else that dies in the accident, it's you that dies in the accident, and it's your fault, so there's no one to sue. Your income, right, that $4 to $5 million that was going to be there to put food on the table for the next 30 years as you raise your family, and then be there to do all the things on that wish list as you retire, put your kids through college, the second home, everything that you've mentioned, that $4 to $5 million goes away, and it's replaced in this instance by about $600,000. So again, what we talked about earlier was in that auto accident, what would that other person, the other person that was very similar to you actually, what would that other person's family want for them in order to continue to live the lifestyle they wanted? We decided that that other family would want full replacement of his earnings potential, right? We said at least $4 million, and then pain and suffering and loss of dad and loss of a husband and loss of a soccer coach and everything else will push that number probably up to like $5 million, right? So in the same instance, when the shoe's on the other foot and now you're the one that is lost, your family, instead of getting that $4 to $5 million that they deserve, is only getting the $600,000, right? So if there was a significant reduction, we got to look at how would your family adapt to that situation. So what I want to show you is, and I think the issue with life insurance is that the amount, $600,000, sounds like a lot of money, but I think what you have to look at is the $600,000 is not really the benefit that they're receiving. It's what can the $600,000 do for your family going forward in the form of income, right? If something happens to you, John, your family loses obviously you, and that's a huge deal, but they lose your income for the next 30 years. So life insurance is an income replacement tool. And so we need to look at how much income would that $600,000 produce. So let's close this out, and I want to take you over to a little tool that measures how much income $600,000 produces. So I'm going to click on a tool called Economic Retirement Factors. And we're going to type in that $600,000. So think about that. So John, if something happened to you, Mary and the children are now on their own. Mary's working, earning $50,000 a year. You are earning $200,000 as a family. So there's a $150,000 reduction in your total family income, right? So it's a huge adjustment, right? But luckily we have the $600,000 of insurance that now comes into play. But let's see how that would affect Mary's income going forward, or the family's income going forward. So let's first think about how long does that $600,000 need to provide income for Mary and the children? Does it just need to last for a few years, or does it need to last at least as long as the children, would it at least need to last as long as the children are there? What about after the children leave, and then between that then and then when Mary retires? Would you want it to be able to help Mary to supplement her income and to be able to continue to save for retirement, just like you would have been able to do if both of you had been alive? And then finally, would you want that money to be able to support Mary in retirement, to be able to produce retirement income the same way that your retirement savings would have produced income for Mary in retirement as well? Right? So when we look at how long that $600,000 needs to produce income, it's not for just a year or two. It needs to produce income for anywhere from 30 to 60 years, right? 30 years just gets Mary to retirement, and another 30 might take her through retirement, right? So any from 30, 40, 50, 60 years is how long this thing has to produce income. So let's change the study period here to, well, let's choose 30 since that's the longest period of time we have available here. Now, what this is saying is that in order for that $600,000 to produce income, it would need to go and sit in an investment account, perhaps in a trust, and then the trust would dole out income to Mary on an annual basis going forward, in a way replacing the income that you would have earned if you were alive, right? And so a portfolio that's producing income on a regular basis can generally produce about 4% a year. That's a common assumption that's used in the financial planning industry. It's called the 4% rule. It's used a lot in retirement planning. When people retire, they generally say that a portfolio can produce about 4% of income per year without running out of money during a person's retirement. Now we're looking at 30 years just until Mary retires, and then additional maybe 30 years while Mary's in retirement. So I would be uncomfortable using anything more than 4%. Now, all the income that comes off that portfolio also could be subject to taxes as well. Dividends from stocks, interest from bonds, and other investments. So let's use a fairly low tax rate. Let's try 20% when you add up state and local. And I'm going to click on details. And so what this is going to do is calculate how much income is produced off of that $600,000 portfolio. So $600,000 at a 4% interest rate produces about $23,000 a year. You pay taxes, and Mary and the kids are left with about $18,000 a year of after-tax income. So let's just say that after the funeral, the funeral's on Saturday, family and friends are there on Sunday, and then on Monday morning, Mary's back to work, right? In her same job, doing the same thing, working full time, earning her full $50,000 a year that she was earning before. She would have that $50,000 plus the $18,000, so she would be, let's just call it $70,000 a year of income. So again, your household income has gone from $200,000 a year down to $70,000 a year. I guess my question to you would be, what would have to change in the life of Mary and the children because of that huge reduction in income? Would Mary and the kids maybe have to change homes? Would they have to downsize a little bit because of the burden of the mortgage payments? Would the kids perhaps have to go to a different school because the $70,000 isn't enough to support them going forward? So this is what we worry about, is that $600,000, while it sounds like a big number, from an income perspective, it doesn't go very far in replacing the income that you were producing as a family. So if we flip back to the current overview, under life insurance, we see underinsured, we see your $600,000. So then we can look at, well, what's the total amount of insurance that you would be eligible for? And so there's a rule in the insurance industry that basically says because you're in your 30s, you're eligible for about 20 times your income. So John, you make $150,000 a year. 20 times your income would be about $3 million. So you're actually eligible for about $3 million, and Mary is eligible for 20 times her income, which would be 20 times 50,000, or $1 million a year, $1 million. But Mary is automatically eligible for at least half of what your eligibility is, John. So if you're eligible for $3 million, Mary's eligible for $1.5 million, $1.5 million. So in addition to the $600,000, John, we should really be looking at another $2.4 million of additional coverage to get you up to that $3 million mark. So let's go back to the wealth distribution tool here. And let's see what it would look like if we had the $3 million number in here. So let's put in $3 million. We still have our 4% and our 20%. Let's hit recalculate. So at $3 million, that would produce about $115,000 a year. We pay taxes and we'd be at $92,000. So it's not a full replacement. The $115 is not a full replacement. Just like we talked about in the disability, it only replaces the disability income only replaces about 2/3 of your pre-disability income. The same thing on the life insurance. It's not going to be a full replacement. So there's no worry that you could ever be overinsured, right? There's no worry that you could be worth more dead than alive. I know people joke about that, but the insurance industry won't let that happen. They won't let a person be able to earn the same amount of money disabled as they could if they weren't disabled, because then people, not you, but people would find a way to be disabled, right, if they could earn the same amount of money. So that's called a moral hazard. So the insurance industry creates a gap between what you could earn and what you're worth as a working individual versus what you could have as a non-working individual, either in the form of disability or death. So 115,000 plus your 50 puts you in the 165, 170 range. And so that keeps things fairly consistent and allows Mary to continue to live, to be able to continue their lifestyle, her and the kids' lifestyle going forward. And I can just tell you from hearing stories of people that have been through this type of event, the other thing that $3 million of cash does is it buys Mary time. There's going to be a lot of things that Mary's going to have to go through, a lot of decisions she's going to have to make, a lot of just legal documents that she's going to have to pour through, proceedings that are going to take place, everything, right? And so that's a lot. It's taxing, and it's going to be emotionally very difficult for her as well. I don't want her to have to be in a position where she has to go back to work on Monday because she is so tight with money that she is just like fighting tooth and nail for every dollar. So the $3 million, in addition to allowing your family to continue the lifestyle and the dreams that you have for them, the $3 million also buys Mary time so that she can make good decisions, she can take care of the kids, take care of her family, recover emotionally a little bit before she then tries to go on with the rest of her life. So if that makes sense, what I think we should do is, again, just go through the next steps of figuring out, number one, if we can get you $3 million of coverage, and then if we can, how much it would cost, right? And then what we'll do is, once we know how much it costs for the $3 million, they actually basically give it to you in a rate standpoint to where we can figure out how much it would cost for 2.5, for 3 million, or anything in between. What we can do is we can look at it compared to the MetLife contract, and we can see, does it make sense to keep the MetLife policy in place because the premiums are a really good price for the type of product that you're getting, or should we look at getting rid of that and moving it over to a new policy because we can find a better deal? So that'll be all part of our analysis that we'll do. But in order to do that, the first step is to, again, go out and find out how much this costs. So this is very similar to the disability insurance in that we need to take an application, fill out the application, and then we can actually use the paramedical exam that we're already doing for the disability for the life insurance as well. So we'll be able to kind of kill two birds with one stone with that. So all we really need to do is fill out this additional life insurance application. A lot of the same questions, and get those signed, and we'll go ahead and start the process of figuring out how much they say you're eligible for, because they're going to look at your health history and your earnings history again. So they'll tell you how much they're eligible for, if you're eligible from a health standpoint, and then how much it will cost. And then from that, the three of us will be able to sit down in a future meeting and look at how much money you have coming in, how much is going into your world from a cash flow standpoint, how much these things cost, and be able to make intelligent decisions about what we put in place. But I'm a big fan of you having that full optimal protection, that $3 million in place, because as you saw, the $3 million will never fully replace your income. And just to add one more little piece to this, the other issue is that $3 million is a static amount. It'll never be more than that. And the income coming off the portfolio is going to be subject to inflation, right? So if we added in inflation in this, we kept our 4% rate of return, we kept our 20% tax rate. What we worry about over time is if we get rid of the sidebar here. When you look at so this is the same thing, the $3 million, the same $115,000, the same $27,000. Sorry, let me fix this. The same $23,000 in taxes, the same $92,000, but we added a column here called inflation adjusted income. And what you see is the $92,000 happens every year, just like it does on the left-hand side. But the inflation adjusted column shows now what would that money feel like, right? Because of inflation. So bread and milk and gas and your water bill and your cell phone bill and everything else in the world is going to continue to go up at an average rate of about 3 to 4% from an inflation standpoint, right? So the world around you is getting more and more expensive, and your income is staying level. So your spending power decreases over time. So what feels like $92,000 now, in 18 years when the kids leave for college, that $92,000 may feel more like $55,000, right? So even though that $3 million seems like a lot, and even the income might feel pretty good right now, it's never, ever, ever going to be able to fully replace what you would have been able to bring to your family, because you are making $150,000 a year and you fully expect to earn more in the future, right? So your income is continuing to go up every year, and this income from the portfolio relative to the price of everything else is continuing to go down. So that's why I would press you to have that full $3 million if you can possibly have it. And then the same thing for Mary. Mary at $1.5 million, if something happened to you and you passed away, John, you're going to be in the same position where going to work on the Monday afterwards is not going to be a possibility, right? There's going to be emotional issues. Mary, I know you do the majority of the stuff with the kids around the house and getting them ready for school every day and taking them to the, getting all that put together. So, John, that's going to affect your ability to work and to earn money, and there's the emotional aspect of it and everything else. You need to have this protection in place so that you can get through those first year and a half, 2 years of adjusting, and then also be able to continue to have your income coming in, so that the kids, if they lose one parent, the other parent isn't forced financially to do so much that they don't have time to be a good parent to the kids, right? So you'll hear, we'll kind of use this terminology every once in a while, that we don't want the loss of one parent to create effectively for the children the loss of two parents, right? Because the second parent is stretched so thin financially that they're having to work 2 jobs or whatever they have to do to get by. So this gives you a little bit of padding. Certainly won't replace your income fully, but puts you in a position to be able to take care of the kids, to be able to handle all the emotional aspects that come with this, because we know that we've done everything that we possibly can from a financial standpoint.